Hello, my name's Andy Critchlow. I'm head of news at S&P Global Commodity Insights, and welcome to the Look Forward podcast from S&P Global. In today's rapidly shifting markets, success depends on anticipating what's next. The professionals who excel are those who can spot emerging trends before they fully materialize. The Look Forward podcast delivers exactly that. Insights to help you prepare for tomorrow's opportunities and challenges. We bring you expert perspectives on macroeconomic trends, capital markets, energy transition, and global trade, with a sharp focus on what these developments mean for the decisions that will shape your tomorrow. This podcast connects you with S&P Global's Look Forward Council, bringing cutting-edge research on long-term trends and transformative market shifts. Together, we're committed to providing the forward-looking intelligence you need to navigate uncertainty with confidence. Welcome to this episode of the Look Forward podcast. My name's Andy Critchlow. I'm head of news at S&P Global Commodity Insights, and I'm delighted to be joined today by Paul Gruenwald, chief economist at S&P Global Ratings and S&P Global, our chief thinker, in actual fact, on all things economics. And Paul, you've been at the IMF meetings recently. I've been at a few things in the City of London recently, and everyone who was there, they were all saying, well, we heard this at the IMF meetings and we heard that at the IMF meetings. And I, like many of our listeners, was not there. So I'm relying on you to shed a little bit of light. What was the big theme that you took away from that?
Yeah, well, let's remember this happens every 6 months. So there's a spring meeting in April and there's the fall meeting or the big annual meetings in October. So our main takeaway was a sense of relief that the economic impact of the tariffs was smaller, at least so far, than we had previously expected. Let's remember back in April, that was right after the so-called Liberation Day tariffs had been announced. There was a huge amount of policy uncertainty coming out of the U.S. There were tariff rates we hadn't seen since the Depression or even the late 19th century. Economists were marking down their forecasts. We were less extreme than others. We didn't have a recession, but certainly we were seeing lower growth, lower spending, lower confidence. And as it turned out, economies have been pretty resilient. Consumers are still spending. The impact of the tariffs, which is still feeding through, wasn't quite as bad as we thought. But I think the big takeaway for us was the sense of relief that the system held better than most of us thought.
What does that relief actually look like in numbers? Where are you percentage-wise on growth this year?
Yeah, well, I'll use the U.S. as an example. The U.S. is a 2% economy. That's the sustainable growth rate. Let's remember, we came into this year a little bit hot. Growth was 2.9 in 2023 and 2.8 last year. So we thought we'd be slowing to 2. The first quarter GDP actually tanked in the U.S., but that's because we had a lot of front running for imports, and imports are a negative number in GDP. We had a big bounce back in Q2. So first half of the year roughly came out at 1.5, which is kind of the slowdown we were expecting anyway. It looks like the third quarter was another strong quarter, although the government has stopped producing data, so we don't have the final word on that one. But again, it was a little bit slower than we had last year, but certainly not the kind of devastation we were looking for. And then globally, kind of think of a global growth rate. 3.25 to 3.5 is where we've been for the last decade or so, and we're kind of around 3-ish. So moderate slowdown, but again, certainly not the deep recession that some people were looking for at the start of the trade war.
Where does China fit into that picture?
Yeah, well, China's still numerically the largest contributor to global growth, even though the days of 7-8% growth are behind us. It's now kind of a 4 or 5% story. China alone is contributing more to global GDP than any other countries. I guess there's a mixed story for China. I'm going to do my on the one hand, on the other hand thing now. I think the negative story is the the property overhang and the structural overinvestment model that China's never really managed to shake. It's still a centralized model with state banks, state enterprises, local governments. That whole nexus in property. There's been some overbuilding and pretty high youth unemployment and some weak consumption. The good story for China is their world-beating EV industry, their world-beating battery industry, quicker decarbonization of the economy, and something that's very important. We published a paper back in August. The credit team actually led on this. Was the reorientation of Chinese trade away from the Americans and the Europeans toward the global South. So that's not just Southeast Asia, it's the Middle East, it's Latin America, it's Africa. So China's trade to those regions is booming. That's obviously keeping China's economy afloat. It's allowing those countries in the global South to electrify and decarbonize faster because it's got a big clean tech component. I think the challenge there is China is so efficient at manufacturing, partly because of the talent and partly because of the subsidies. They're just potentially going to devastate anybody they trade with. I think Southeast Asia is in the crosshairs there. But bottom line, we're continuing to see China slow a bit, but still a big contributor to global growth. We're probably, going down from 5 to 4.5 the next couple of years.
Yeah, we spoke to the team behind that report, and it's very interesting how China's really doubled down on investment in Africa, on trade with Africa. It's kind of been almost a response to tariffs. I think that at the same time, you had the US introducing tariffs internationally to various countries. You had China actually cutting tariffs to trade with Africa at that time. So it's an interesting developing story. How much do you think that this sort of, I guess, soft landing for global economics and markets is also down to markets getting more comfortable with Trump? Trump, he says a lot and, does a lot, but also, some of those words and some of that rhetoric doesn't actually turn into action. I think people have called it, the taco. Trump always chickens out. Are people more comfortable kind of predicting his next move now?
Well, I think he's by design unpredictable, so that might be a bit of a mug's game. But I think you're right. I think the model, to the extent we knew the model from the first Trump administration, this is maybe a slightly more energetic model, if that's the way to put it. But we know that the initial announcements on things like tariffs, even though they're quite shocking to sober bureaucratic types, these are seen as negotiating tactics, and we eventually settle down to something that's more digestible. A world without tariffs and a world without policy uncertainty coming out of the U.S. is, in my humble opinion, a better world than the one we're in now. But I think markets kind of get this. Countries are, they're risk adjusting their supply chains and financial flows, etc. We've seen moves out of the dollar to gold. We've seen countries, pivoting their exports. That ranges from Canada all the way to Southeast Asia. So I think the world economy is getting a little bit more comfortable. So the downside scenario is probably off the table for the time being. I know we're going to talk about AI in a bit, Andy, but this AI investment boom is also masking some weakness in the global economy. So although the headline numbers that we've been discussing are pretty good, again, look at the US. The labor market is only really producing jobs in one sector, which is healthcare. The investment part of the economy is only producing, new capex expending in one sector, which is data centers. And then the top 10% or so of consumers are driving at least half of consumption. So I think we need to look past some of the headline numbers, which again aren't bad, and look at the foundation of growth these days, and it's actually quite narrow.
So on that subject of AI, I read your report following the IMF meetings, and you've attributed quite a chunky number for AI's contribution to growth now, right, globally.
Yeah, well, it's mainly a U.S. story so far. Well, it's also a China story, but we don't have the data from China. So we have a paper coming up, as you know, for the Look Forward Journal on the macro effects of AI. But we did do a little summary for the recap of Washington Week. There's a bunch of, I guess, factors or components to the AI story. It's physically building the data centers, which is showing up as business construction in the national accounts. But also you've got the equipment, which is the racks and the servers and everything else, which is the hardware. And then you've got the software running the large language models. You've got the energy components. So we don't have an agreed all-in measure on the contribution of AI and data center related spending to growth. But most people are putting this between 1/2 and a full percentage point contribution to growth. So think about that for the US, right? The US is a very sophisticated, broad-based $30 trillion economy. And we're basically saying that if you flatline everything except data centers, you're still going to get GDP growth of close to 1%. So that's a bit mind-boggling. The way I try to think about it is maybe recall the building of the U.S. interstate highway system in the 1950s. This is the digital version of that being done by a handful of hyperscalers, but it's really moving the needle. The CapEx story is running, I think, ahead of where most analysts put it in recent years, and it's going to last for a few years. And then the rest of the world. My colleague Sylvain Boyer in Frankfurt, who's our chief EMEA economist, he's been noting that the exports of tech-related goods from Europe is adding to growth there. They're not building the data centers, but they're supplying some of the inputs into data centers. So it's not just a U.S. story. We're getting kind of ancillary benefits even in places like Europe, but definitely a tailwind maybe for the next couple of years.
Although it's a tailwind, there's also some challenges. I guess this AI boom also brings with it inflation in terms of higher energy. Is that a factor?
Well, we've been supposedly in a world of a savings glut for the last couple of decades. The other way to say that is we've been in investment shortfall. So this is pushing investment up. It's pushing at least sort of structurally real interest rates higher because of investment demand. Yes, it's pushing up energy prices. There's some distributional issues there. So those are all happening in the short term. What we're actually starting to focus on is what happens after all of these things are built out. Are they going to generate the profits and the earnings that are into some of the equity prices, right? The PE ratios for some of these hyperscalers are quite high. That's the financial story. Who's ultimately holding the risk if that goes bad? And then on the macro story is AI and data centers and everything related. Is that going to deliver the productivity gains? And maybe we get a windfall of, economists are thinking half a decade of above trend growth. Estimates are pretty broad, but we might be getting a growth windfall out of AI as well. And how do we spend that? So this is the very beginning of the story, the kind of the CapEx and the build out phase. And then we've got the financial payback phase and then the macro productivity phase. So I think we're going to be talking about this as a needle moving part of the macro story for years to come.
Were there any policymakers at the meetings that were expressing some reservations or concerns about ultimately what it could mean for employment? Because that if you're a politician, that's the thing that really moves the dial for you in a bad way, right?
Yeah, that was a subject of some of the panels, and I think we're already seeing some of this. To be frank, some of the larger firms are announcing layoffs or slower hirings due to the effects of AI. I think we know, Andy, that on impact, we're probably going to have a negative impact negative effect on the labor market. But as we go forward, we're going to find new products and new applications for AI. So the good story, and we're not there yet, but the good story is, yes, we take a hit to employment at at year zero, and then as we build out and look at the capabilities of AI and the new possibilities, and the labor force can hopefully adjust, we get a better story. Electricity. Sometimes people compare AI to electricity, and on impact, electricity put the candle lighters and other folks out of business as we electrified the economy. But then we discovered we could use this stuff for assembly lines and things like that, and the whole economy restructured. So this is a huge thing, and it's going to take years. But employment impact was front and center for a lot of people, including here in the U.S. We're already starting to see some impacts on the labor market.
The ancient ever constant tale of markets. There's winners and losers. De-dollarization, that was another subject that you flagged, getting a lot of attention at the moment, especially with gold, where it went recently. We were above $4,000 a troy ounce. It's come off a little bit, but you've had this kind of percolating chatter around de-dollarization, used maybe as an excuse or a justification for capital going into alternative assets, gold, maybe crypto. How serious should we take it?
Yeah, well, I mean, I think the starting point there is the global economy has become more broad-based over the last couple of decades. We've now got U.S., Europe, and China, roughly 20% of global GDP. But the dollar still reigns supreme, right? It's almost 60% of assets on the balance sheets of central banks. It's even higher for a lot of international transaction. And the U.S. administration is rethinking the benefits of globalization and these institutions that the U.S. helped to build after the end of the Second World War, IMF, World Bank, and what eventually became the WTO. The U.S. seems to be pulling back from some of its commitments there, but yet we're still in a dollar world. So this issue comes up a lot. What's going to happen to the dollar? We've got this apparent mismatch between the financial world, which is very dollarized, and let's call it the real economy world, which is much more diverse. The bottom line is there's no substitute for the U.S. dollar in the global economy, right? It's not just the dollar, it's the treasury market. It's the deepest, most liquid, most sophisticated financial market in the world. And if you want to hold foreign assets, if you're outside the U.S., you probably want to do that in U.S. dollars. Yes, we've seen a gradual movement away from dollars, but as you said, it's toward gold and not other currencies. And the euro market just doesn't have the depth and breadth and sophistication of the US. And China is an economic powerhouse, but still kind of a financial underdeveloped economy, very bank centric and very kind of plain vanilla. So, for the foreseeable future, we are in a dollar world, even though we've got all this geopolitics happening, and the U.S., at least this administration, kind of trying to pull back a bit from some of the, historical things that the U.S. did as the benevolent hegemon after the Second World War.
Glenn Stevens, our former mutual friend at the RBA in Australia, I think once described it to me that all of the currencies are bobbing like corks bobbing on a dollar ocean, which I think is.
I like that metaphor, by the way. That's a good one.
So geopolitics hasn't really had the impact that we all feared it would at the beginning of the year. And I guess where I'm going with this, are people talking about a potential peace dividend on the upside here? So we had Gaza, we've now got peace there. People didn't see that. Things are starting to maybe cool down in the Middle East. But the next big geopolitical change in the mood could be around Russia and Ukraine. Can Trump broker a peace deal there? Now that potentially, if it could be done, that would move the dial for forecasts for GDP growth by the end of the year, potentially, no?
Yeah, well, if we dial back a few years, those events didn't move the macro needle as much as we originally thought. Obviously, if you're in Ukraine, you've got a huge impact. But Europe weathered that energy supply shock pretty well. And in the Middle East, growth is holding up in most places that are not directly affected by the hostilities there. So maybe we get a bit of a boost on the market sentiment if those two conflicts are resolved, which obviously would be a great thing. And I think, we might, can't say for sure, we might bump the forecasts up a bit in those regions. I'm not sure it would move the dial very much globally. But, the beginning of your question, Andy, was, this, deglobalization hasn't moved the needle yet very much. And I think a lot of people, I wouldn't sort of jump into this view that it's going to cause a recession. I would look at the longer term, right? So are we getting the same amount of investment? Are we getting the same amount of innovation? Is labor going to where it's going to be most productive? The U.S. is thinking of, putting a high fee on H-1B visas. Are we losing some of the dynamism because of the geopolitics? So this might be a story where not over the next 1 or 2 years, but over the next 1 or 2 decades, we just kind of take global growth down a couple of notches. We all know globalization was about efficiency and free flow of capital and free movement of labor and production moving to where it was most efficient. But now that we've got this geopolitical overhang, that's going to be dialed back, and I think populism is probably with us for the foreseeable future. So for me, that's just a less dynamic, slightly more expensive, and a slower growing world. So again, I wouldn't sort of look at it as a short-term, short-term cyclical risk of a recession. Let's say maybe a longer-term decline in trend growth.
So tariffs aren't going away.
Nope.
Deglobalization isn't necessarily going away, but it hasn't been as bad as anyone thought. The dollar's not going away. AI centers are definitely here to stay, and we're likely to get more of them. And actually, we 2025, we could all end up finishing the year smiling. Ultimately, it's not been as bad as people feared.
Yeah, I think that's right. And I think you listed all the things that are helping. And I would add to that maybe lower global oil prices. Those are obviously not great for the producers, but for consumers, particularly in emerging markets where you've got a big chunk of their spending on energy, that's another tailwind to growth. And then financial conditions, which we follow quite closely in the ratings division, medium term, 5, 7, 10-year U.S. Treasury yields are pretty low. They're at or below 4%. The spreads on top of those are pretty tight. People have got nice equity portfolios because of the rise in the various indices, and housing prices are still pretty elevated. So the financial conditions as well are pretty accommodative. So we've got some tailwinds to growth with AI and oil prices and financial conditions. So we're going to end the year probably with some decent momentum. And again, I would focus more on the medium term, but the short term, we've revised our forecasts up for the past 2 quarters, and 2026 looks a bit better than we thought earlier in the year. So yeah, short term looks like the damage hasn't been as bad as feared.
Well, as a professional pessimist, you made me feel quite good about things. So, Paul, that's mission accomplished. Thank you very much for joining us.
Well, make it end by quoting Madeleine Albright, our former Secretary of State. She said, "I'm not a pessimist. I'm an optimist who worries a lot." So that's the way
it is. Actually, the way to be, certainly in financial markets. Paul Gruenwald, Chief Economist at S&P Global, thank you so much for joining us, taking us through those meetings that you attended this month. We look forward to having you again on the podcast, maybe into the beginning of next year now. And to our listeners, you can download this episode and future episodes on Spotify, Apple Podcast Store, and our website at spglobal.com. Thank you very much.